with easy access savings accounts casually paying out nearly 5% annual interest, and Michael Burry continuing to predict the end of the stock market. Is cash really king, and should we scurry to put all our money into the banks and enjoy the sweet rewards of having no risk whatsoever? So in this video I'm going to be debating the age-old topic: should you put your money in the bank, or would you be better off in the stock market? Both options have their advantages and drawbacks, and in this video we'll explore the factors to consider when making this very important decision. So let's first start by discussing cash. So keeping your money as cash or cash equivalents, such as a savings account or even a current account, cash investments are highly liquid, meaning that they can be cashed out at any time, no pun intended. And generally speaking, cash carries a far less risk than putting your money into the stock market. So let's talk about keeping our money in the bank. Cash overall provides safety and a lot of liquidity. So if you keep your money in cash, you basically have a safety net for your emergency needs. So if you are saving up for an emergency fund, you'd want to store that money somewhere that is very liquid and you can take it out at a moment's notice whenever the emergency arises. If you put your money into an easy access savings account, for example, the withdrawals are practically instantaneous and you'll get your cash whenever you require it. Cash is also far more stable than the stock market or even bonds. So if you're holding onto cash, there is no chance that the value of the cash is going to drop in a bank account, and as such cash has no volatility, ensuring that you always have the amount of cash that you're expecting, of course minus the fees and taxes. So this gives cash investments a more stable and predictable return, making them a great place for short-term savings. Also, if you are risk averse like most of the UK seems to be, storing your money as cash is a risk-free way of actually saving money, and if you're nearing retirement, sometimes that could be the best peace of mind option for many of you out there. However, it's not all sunshine and roses with cash. Like I said, the value of your cash may not go down, so this is the nominal value. It's the number that you see on your banknotes, and it's the amount of credit that you have in your current account. This doesn't go down. However, there is something that does eat away at the actual value of your money. In other words, this is called the purchasing power of your money, or the trade value of your cash. This goes down by a monster called inflation. As we've seen from the past couple of years, inflation can very easily rise to above 10% per year, meaning that the value of your cash, the amount of goods that you can buy from them, can drop 10% in 1 year. And even on a good year, inflation is targeted by most central banks between 2 to 3%, meaning that yearly you're going to be losing the trade value or the purchasing power of your cash. In addition to that, banks are never incentivized to actually raise their interest rates, even when the central bank rate is very high, like it is currently at 5.25%. Banks almost never increase the savings rate, so if you store your money as cash, most of the time you aren't really making that much in interest. Banks will never pay more interest than inflation, meaning that if you store your money as cash, you're always going to lose the purchasing power year on year. With all of that being said, currently there are fintech companies that are paying out interest very close to the central bank's rate of 5.25%. An example is the online savings app called Chip, which is currently paying out 4.84% as an annual rate of return, meaning that if you deposit £20,000, you could be making as much as £950 per year in interest payments alone. So now that we've talked about cash, let's shift our focus to the stock market. The stock market is a place where investors have for centuries tried to capitalize on the growth potential of companies through purchasing shares of publicly listed companies. So the stock market has naturally been a place where investors have for a long time put their money in order to try and beat inflation. Overall and throughout history, the stock market has always trended up. And this is not by an insignificant amount. If we talk about the UK economy and talk about the FTSE 100, which is a collection of the top 100 largest companies based in the UK. So from 2012 to 2022, the FTSE 100 has given an average rate of return of 12.89% per year, when you account for the dividends paid out. So for context, in the same 10 years, the average rate of inflation was 3.65% per year. This means you would be making around 9% above inflation. Now, with your interest compounded, you can only imagine the amount of returns the stock market would have given you instead of putting your money into the bank account. Within that 10-year period of time, most banks would not be paying anywhere near 1%. Historically speaking, the stock market over a long term has always given a higher return than cash investments. Stocks have the potential of capital appreciation as well as dividends that are paid out quite regularly. This is a fantastic way to boost your wealth accumulation. So why do investors tend to look at the stock market instead of keeping the majority of their money as cash? Let's discuss some of the benefits of the stock market. So investing in stocks allows you to diversify your portfolio over various sectors and industries. This is a great way of managing your risk, and with different amount of risks, there are different amounts of reward. Like I said before, stocks overall have always outpaced inflation, allowing you to keep the purchasing power of the wealth you have, in addition to actually building it and snowballing it to something very significant. For example, if you keep all your money as cash and you aim to retire from it, within your retirement period, the actual value of your cash is never really going to grow past inflation, meaning that you have a lot less money to actually spend on than you had initially thought. Stock market investing, however, is more suitable for your long-term goals. In the short term, so we're talking about 1 to 5 years, statistically speaking, you are more likely to lose the value of your money than actually grow it. However, when you talk about terms between 20 and 30 years, statistically speaking, you are very likely to be increasing your money instead of it going the other way. For example, if we look at the FTSE 100 index again, we can see dips of 10% occurring very frequently. This yo-yo or this up and down is called the volatility, and the volatility is a measure of how fast the value goes up as well as down. Now, for a short-term investor, volatility can be very bad, but if you keep investing regularly and put your money into the stock market for many decades, chances are you're going to be making a lot more money throughout the volatility, and that is something that you should not pay your attention to. So given the nature of the stock market, you do not want to be putting your emergency fund in the stock market. Like I said before, in the short term, the value of the stock market can very likely drop sometimes 20-30%, and sometimes we've seen even higher than that. If you need your cash as soon as possible, the stock market is almost definitely not the right option for you. This is because if you need the cash, you'd have to be selling your investments at a loss, which is something that you never want to do. So choosing between putting your money in a bank or putting it into a stock market depends on various personal factors. So let's explore some of these factors. The first is risk tolerance. Be real and honest with yourself. What is your actual risk tolerance? Are you comfortable with the market fluctuations that could often be 30% within a month? Do you prefer more of stability, or can you ride out the waves and sometimes see your portfolio slashed in half, which is any investor's nightmare anyway? So the next is your goals and time horizon. You need to define your financial goals and your time horizon. Short-term goals are often better put into cash where it is highly liquid, while medium-term goals could often be put into bonds where there is a fixed term of 5 years, let's say, but bonds often don't pay the best interest. If you're talking about long-term wealth generation, then the stock market could be the place for you. The next is diversification. You should consider to always diversify your investments over both cash and stocks, and sometimes put in a mixture of bonds too to ride out the volatility of the stock market in the short term. Another very important consideration is your financial knowledge. It is very important to educate yourself about investing before making these big decisions. The stock market often requires knowledge of basic economics and company fundamentals. Although you could put your money into well-diversified index funds, there is never a guarantee that these funds will continue to pay out the way that they have in the past. So I would say a balanced approach is best for most investors. This is where you have a mixture of cash, stocks and bonds just to have smooth sailing in your financial journey. So something incredibly important before considering if you should put your money into banks or the stocks is having an emergency fund. You really should strive to have an emergency fund that covers between 3 to 6 months of salary in case you lose your job or in case something bad happens again like it did in 2020. So easy access savings accounts with high interest rates are a great way to store your emergency fund for the short term. Be careful, however, when you put your emergency fund in the bank, as not all savings accounts are equal. For example, you may be tempted with the large headline amount of a savings account that is paying around 6% at this time. For example, this savings account from Barclays is giving out more than 5% currently. However, if you read the terms and conditions, you will find out that you would need to keep your money locked within that account for 1 whole year, meaning that it is not the best place to be putting in an emergency fund. Likewise, not all instant access savings accounts are the same. Some might offer a higher headline amount just to get you into that bank, but when you read the terms and conditions, you will realize that they have a limit on the amount of withdrawals you can make. If you withdraw more than the amount you're allowed, oftentimes the interest rate can be slashed all the way down, sometimes 90%, and other times you even have to pay a fee if you want to withdraw your money early. So in the end, the decision to put all your money as cash or in the stock market is ultimately up to you. Both options have their advantages and disadvantages, and make sure to check out some of my other videos, and I'll see you in the next video.